Hey everyone, my name's Andy. I'm on with the channel Finding Value Finance. Today I have trader Ferg with me. He's a full-time professional trader investor, and I really wanted to get him on the channel to get his viewpoint, so you guys can get another viewpoint than just mine. So let's walk through a little bit of your background and how you kind of got where you are today through maybe building wealth and how you kind of did it.
Thanks for having me on to start with, Andy. I've just been binge watching your channel the last 2 days, and you're putting a ton of value out there. So I just want to congratulate you for that. And yeah, anyone that's not watching should be binge watching it as well. But yeah, as for me, I've been doing this full time for coming up 6 years now. So I quit my corporate job where I was working as an asset manager just before my 30th birthday. But leading up to that, so I'm off a farm in New Zealand. I grew up sort of in the middle of nowhere in New Zealand, thought I was going to be a farmer, went to university to study agriculture, decided I didn't want to be a farmer when I sort of started to work out the average sort of return you get off a farm and how hard you'd have to work for it. So then I went into property management and development. And that's where I ended up working in Australia, and did that for most of my 20s, and then towards the end transferred sort of towards the more asset management side of it. And that's also when I was lucky enough to meet my mentor, and that's when I was kind of deciding it had always been my dream to kind of work the sort of the good corporate job with the suit and get the corner office and get the good salary, and then quickly decided I was just bloody miserable with it. So I was trying to find a way to exit that. And that's when I was lucky enough to meet my mentor, Brad McFadden, who he's a hedge fund manager. And sort of he agreed to mentor me after a while. And so he's, yeah, absolutely took to the markets and was mentored by him for, would have been about 5 years before I accumulated enough from just saving super hard with a job and also investing quite well with a few bumps along the road. And then, yeah, was at that stage was making enough that I was quite confident, also managed money for some other people. So quit my job when I was working in Australia and moved to Europe. So I went and lived in Berlin for a while and sort of managed money there. Did that for pretty nearly 2 years, and then decided I didn't actually like the way I like to invest. I'm also in very hated sectors. None of the people I was managing money for were particularly liked what I was doing. Like, they didn't like I was going into sort of coal companies post bankruptcy and stuff, and they were telling me you can do anything but you can't do that. And that was generally how I was making all my returns. And so made the decision from there that I've had kind of made enough that I thought I could make it on my own. And so I moved to Bali and just traded my own money. And that's what I've been doing up until recently. It was pretty much as a result of COVID. I started putting far more out there. Just trading is quite a lonely game when you're just doing it by yourself. And so I started putting far more out there, and that opened some opportunities, and now kind of doing more sort of interviewing and presentations with crux investors, been a more recent thing I've just done the last year. And so, yeah, that's kind of my story for how I've got where I have. Yeah.
Okay. And at the current moment, a couple of questions I have for you is, what do you like, and how do you identify those sectors, and how do you identify that value? What's that process step that you have in order to do that? What are some things you look at?
The first is always charts. So I'm always looking. I love nothing more than like a bottom crawling chart, something that's gone sideways for years after what was previously sort of a high flying stock, seen that across the sector, and then just trying to work out why is this happening and when could there be an inflection. Like uranium was the perfect example. It was like, looked at all like pretty much the whole sector looked like it was going bankrupt, and then inherently understand that, well, it's still going to be necessary in the future. And so what is the actual supply demand picture? When is this going to inflect? And then that leads you down the whole rabbit hole after doing, a few years of research, had this sort of conviction to take really big positions and then move on and sort of repeat the process. And it was kind of lucky with uranium that kind of led me down the whole energy rabbit hole. And then that's led on to sort of understanding the entire energy complex. And there's other sectors that, like a big bull on tin. I think tin's quite misunderstood and its role it's going to have moving forward. And from there, I'm quite concentrated. Like I don't, apart from tin, I don't really have much outside the energy realm. Like once I really understand something, I think there's quite a high opportunity cost to moving away from it. If you like, it's one of the questions I get the most is why aren't I in gold and silver? I don't own a single gold or silver stock, and it's just I think I understand the dynamics of energy better, and I think sure I could get a good return in gold or silver, but I think I'd be leaving quite a bit on the table with the sort of the dynamics at play with energy. And so that's sort of an overview how I do it. I'm kind of almost joke I'm like a top-down macro, but it's within small sectors. I really want to understand the supply demand within a small sector, and then I want to sort of work out how to get the most asymmetry with the lowest risk in that sector. And that's very often that's been going into restructurings post-bankruptcy. That's one of my favorite ways to really get a whole lot of free assets. Generally, people in a cyclical industry have got over their skis. They've screwed it up. The equity holders get wiped out. You would then have the debt holders get a debt for equity swap, step in. They're very much incentivized to have the company survive and do very well, and you just step in next to them. And usually I'm far more comfortable taking really heavy positions when I see that. And so that's been a lot of how I've gone about it, or how I spot sectors.
Yeah, and sometimes in bankruptcies, what I see is they release warrants, and sometimes I buy the warrants and ride those things higher. So you said you went and jumped down the rabbit hole of the energy sector, the energy returns. Can you explain kind of what energy return on investment is, and kind of what that means for investing? Because I think that's kind of, we were talking pre-taping on energy return on investment, kind of go down that route of what that is.
Yeah, certainly. So I think that's the most, it's going to end up being one of the most important things to understand for the next few years, because it's almost been forgotten. So the guy that came up with it, Charles Hall, he was spot on with everything he was observing, but largely as a result of kind of cheap energy from shale, his work all got kind of put in the archives, and everyone's kind of forgotten about it. And yet when like, to take the big picture, like energy return on investments, what's kind of driven humanity's progress in a very simplistic way. Like you can look at 12,000 years of human history. Population largely went nowhere because we couldn't get above roughly a 10-to-1 energy return on investment, and that was because we were just burning wood. So until the 1800s, where we had what was known as the Enlightenment period, and we started to sort of capture fossil fuels, first coal, then oil, then gas. Until then, we couldn't really break that 10-to-1 energy return on investment. So once we did, our population exploded. And so you can see this on a chart from, we never got much above about 600 million people right through to the 1700s. And then now we're at, obviously 7 billion. So it's just an absolute hockey stick of a chart. It just goes absolutely vertical. And I think people have forgotten that. Like, it's the most quoted statistic now is sort of levelized cost of energy. No one wants to talk about energy return on investment. And it's almost like it is a completely misleading metric, because it papers over everything that's important and everything that has kind of led us to where we are. Because without energy return on investment, you don't get the surplus energy to sort of essentially build out society. Like, I've got this this analogy that I took from Charles Hall, who he started it with just saying it's essentially the idea of a cheetah chasing wildebeest. And so that cheetah, it needs the wildebeest because it's going to give a certain energy return on investment to go home, feed the cubs, and also on a grander scale, make sure that the cheetah coalition, it's a group of cheetahs, if you didn't know, can move forward. Yeah.
So on the channel, when I don't know if you know this or not, but
No.
as a chart pattern breaks out, it gets released into the wild, and I call it a cheetah. And then
Okay.
and then when I have all these stocks, we call them cheetahs, and we call it the coalition because it's a group of cheetahs. So it's funny you bring that up. It's really funny.
Yeah, I didn't know that. No, I haven't seen that video yet. Yeah, but so it's the idea of this. Cheetahs have grown fat on wildebeest, and the whole species is moving forward as a result of this like excess energy, which is kind of easy to picture. But what we've got now is this idea that we can, for whatever reasons, our coalition of cheetahs has decided that it's more friendly and green to hunt rabbits because they breed quicker and it's easier. And yet the problem is, as a cheetah, to hunt down a rabbit, you're getting maybe a 1-to-1, 1-to-2 energy return on investment. So if you go out and hunt a rabbit and you're not successful, you've actually lost weight. And now not only are you actually technically starving, you're losing your own fat reserves, you can't feed your cubs, and you can't move the whole species forward. And that's kind of where we find ourselves today, is we're trying to optimize chasing rabbits and sort of forgetting how we got so fat in the first place was with this high energy return on investment. And that's a lot of the way I view the world now is kind of branches from that. I think what we're going to look back on this period was quite sort of a delusion of thinking that we could run the world on a very low energy return on investment. And we're going to go through an extremely painful period in a lot of ways until we go back to climbing the energy density ladder. And that will be back to fossil fuels to an extent, and hopefully higher to nuclear. Nuclear is what I always try to be optimistic, and I'd love to see sort of SMRs that you've got hot electrolysis where you could put out hydrogen. That hydrogen could be used for fertilizer. That hydrogen could be used as sort of a replacement for still essentially an internal combustion engine. But yeah, that's me just trying to see sort of the good that could come out of this in the future. But I think we're in for probably an extremely painful decade as we work out this sort of basic reality.
So you say we're entering what we could be a painful decade. And I'm guessing you're referring to renewables and electric vehicles, probably more renewables at the moment. What's wrong with renewables? What makes them either good or bad? And is it the energy return on investment that's making them so horrible of an investment?
So it's a lot of things. Yeah, I'll start with solar in particular, because I think solar is probably the most egregious of them. So Charles Hoare, he got kind of annoyed with a lot of the energy return on investment statistics being put out on solar. So they were putting out sort of 10-to-1, even 15-to-1 for solar. The problem with that is a lot of that was they weren't incorporating in all the costs. It's kind of this, the more I've dug into it, a lot of the studies like to leave out the cost of polysilicon. So the actual manufacturing process and how energy intensive that is. And we're finding that out on the back end as those costs climb, like solar costs are exploding, when everyone had just forecast them to keep getting cheaper forever. And so with solar, he came that it was sort of at best sort of 3-to-1, if not 2-to-1. And so you come back to that sort of cheetah problem that's chasing rabbits. But with solar, there's a whole lot of essentially fundamental flaws that mean it's just completely, it's the wrong energy source to move forward with for humanity. So the first one is, people always love to say, oh, it'll just get more efficient. Well, there's something known as solar deflation. So solar doesn't match the duct curve. So that's the way we use energy. We use more energy in the morning. We use more energy in the evening when we get home. And solar, I'll say, is peak generation in the middle of the day. So even as it gets cheaper, you're putting more and more generation into what is essentially a useless window, because we don't have the capability to store that energy and move it into a useful window. And the problem is, I've dug into, for one example, the AC growth globally is absolutely massive in hot areas, but the majority of that is coming at night. And so you've got a huge energy growth and base load that doesn't match solar generation at all. So no matter how cheap you get it, even if you drive prices negative, which we're seeing, it's of no use to the grid. It's almost like worthless energy. You're seeing curtailments where there's just oversupply at a time when no one needs it. Sorry, it just popped up. Yeah, and that's one point. You've got another point, which is just the fact of seasonality, which never gets mentioned. So if you're going to install it in almost any European country, you're going to receive 50% less generation in the winter months as compared to the summer months. And so that would mean you need an awful lot of battery storage to smooth that out. And as we touched on before, I can go into the whole battery storage side because that ties into EVs as well. But yeah, just needless to say, it's not possible. You've got the fact that the lifespan of solar is quite short. So everyone likes to call them renewables, or none of the inputs are renewable. The recycling's come a long way, but still it's very hard and expensive to recycle solar because none of the pieces are actually particularly have a particularly high value. So you have to do a lot of recycling to get very low value materials. So the economics of it are pretty tough. You have, yeah, sorry, I could just go on and on with a lot of these. Yeah.
Here's a question or a thought I always had. It seems like everyone's migrating to renewables. And what I mean by everyone, I'm saying governments are pushing the renewables. They're pushing all these things. They're putting stimulus and all that stuff. It's their option A plan, and it's their only plan. What if that fails and they are underinvesting in what we consider to be the high energy return on investment fossil fuels? What kind of problem or predicament are they going to get themselves into if option A fails for whatever reason? It could be a shortage of minerals. It could be something that we couldn't integrate into the grid. It could be a electricity storage problem. Like, do you look at it from that sense, or do you look at it from a different angle where basically they're banking on everything to happen in option A, but if option A fails, we as investors in fossil fuels make copious amounts of money because we're basically shorting that option, if that makes sense. Is that kind of your same viewpoint, or do you have something similar to that?
No, it's exactly how I view it. So if you look at any of the IEA or the Bloomberg Green or any of their predictions of where, because IEA has 90% wind and solar by 2050. So that whole band of wind and solar just say not going to happen. And something else I didn't touch on with solar is a lot of the world just isn't suited to solar in terms of like capacity factor. Like Germany is only averaging 10% capacity factor, whereas everyone likes to use nameplate and say it'll produce at least 20%. And so there's kind of a problem of high grading of solar, like a nuclear facility, a gas turbine. It's always going to have a reasonably similar capacity factor because it's you're just dealing with the same makeup. Whereas with renewables, you actually high grade renewables as you install them because the best spots go first. It's kind of what Germany's running into with onshore wind. Is the problem is all the best spots went first, and that's the capacity factor that they were working off. But to answer your question, the kind of optimism on renewables, like sort of building out this all this additional capacity in the future, and the understanding that it simply can't happen. It's not well suited to. There's like lots of areas in Asia that are just windless, so they can't even. They're not suited to wind turbines, and so you've got to say, well, what's going to take up that slack? And it's coal. It's baseload energy. Most of Asia doesn't have a lot of gas, and as we're seeing, people like to sort of use natural gas and LNG interchangeably, and I think we're seeing the flaws in that at the moment. Is LNG is hugely expensive when you take all the infrastructure and shipping involved. And so it really is coal's going to benefit from the stupidity, and we're even seeing it benefit in places like Germany. Like they're having to run all their coal plants at full utilization because yeah, it's the renewables essentially not underperforming. They're not keeping up with the generation that they thought they would produce. So yeah, coal and nuclear are my two sort of big ways to play this. I hope nuclear wins out. It'd be nice to see the and we're starting to see the ships slowly turn in Europe, but in Asia, where you're not even going to break ground on a nuclear plant until this is really bad, then coal's the winner for the next decade. And with the way that all the companies are priced, I think it's going to be essentially the tobacco trade all over again. You're going to have no one still wants to touch it. You're going to get no margin expansion. So you're just going to have giant free cash flow that they're just going to have to either pay out as dividends, share buybacks, or hopefully they have some nice development projects that they can do via their own cash flow.
So of the energy group, and I know you're playing a lot of energy, what do you consider to be the best value at the moment in the energy sectors? Which ones do you like the best? Which sector?
Probably coal. There'll probably be a tie at the moment of coal and some of the offshore oil. So I think oil is going to have an inflection similar to what sort of the whole natural gas and coal space has gone through going into this winter, and it's going to become more apparent in the coming months. And so we're going to see something like that take off of oil, because people just really don't understand the big picture of oil. Like a simple kind of macro overview is like we need to be adding an awful lot of it just to keep up with sort of global demand. Like we as the sort of developed countries consume sort of 12, 13 barrels per person per year. And we have the developing world is only consuming sort of 3 barrels per person per year currently. Well, their demographics alone, just the amount of people they're adding, like 2 billion over the next by sort of 2050-ish. Well, that alone, that's going to add sort of 50% to the energy system. So that's easily going to keep us growing at that kind of historic rate of give or take 1% growth in sort of in oil. And that's needless to say, a lot of these countries are at their kind of start of their S curves. So if you see them start to accelerate, like maybe it's not, maybe it's only from 3 to 4 barrels, that still doubles their whole energy system because you're talking so many people. And it just, no one mentions this. Everyone sort of thinks that we can, what we're doing at the moment is we're not even replacing a lot of the stuff we're taking offline, because that comes back to the capacity factor, which is, it's just stupidly simple. But if you take a nuclear plant off that is has a name plate capacity, I don't know, sort of I don't know, just use the measure 100 gigawatts, and you replace it with 100 gigawatts capacity of renewables of say wind, well, one runs at a sort of an 80-90% capacity factor, and the other is sort of 20%. So you have to, it's not a apples for apples replacement. You're
going to have to do 1 divided by 20% and build that out if it's a 20% reliability. So that'd be 5 times as much.
Yep. And then batteries, and then can we go down the whole sort of battery, because a lot of what we're doing as well can look great at tiny scale. I often get people pointing out how well kind of solar works in like a sort of a domestic setting, and I don't disagree with that. A lot of the stuff can work very well at a small scale, but as soon as you start saying that we can operate this at sort of the majority, we can run the entire grid on it, that's a fairy tale. And it's gonna, we're already seeing that with the likes of Germany. They've essentially got 2 different generation grids. They've got this renewable grid they've built out, and they've got their old grid, which is running at as fast as they can to try and supply baseload, because they don't have any storage capacity to manage out their renewable generation. And I think we're going to see them be the kind of the example of what not to do.
Yeah, the one thing that gets me with renewables always and maybe it gets you too, is they're separated apart, very far apart. And the way they connect them all is through copper and all these different minerals. And it's like, if we run into a mineral shortage, it's going to force them to run fossil fuels and go to something like nuclear, which saves on materials. And I don't think a lot of people really think about that. They just think, oh, we can spread all this stuff out, but really you want to consolidate it, generate it where it's going to be used, and use it there. Another thing, I mean, obviously you've got your sectors that you like and whatnot. How does someone with not a lot of capital, say maybe $10,000 or $20,000 that they have in savings, how would they approach the energy sector and investing in energy? Like, what would be the best approach, you think? And also, maybe you could tie into, since you've kind of done it before, how are you building your wealth? How did you get to where you are today? So you can kind of tie these things in together if you'd like. You say, well, if I had 10 grand, I'd do it this way to basically rebuild your wealth up to where you are today. How would you do that? What would be the approach?
Yeah, so there's a lot to dig into there. So I guess to start, like my horrific experience at the start was I was only earning sort of 40, 50 grand a year, and I managed to save I think it was about 20. So it was saving really hard at the time, living in Australia, which was extremely expensive. And I actually did quite well my first year, and my broker went under. So they were trading in their own account and dipping into client accounts, and then lost their whole account. So number one is make sure you know what broker you own. Like, there's nothing quite like being set back by having sort of dodgy brokers take your money. So
that's absolutely horrible. Sorry to say that, but
yeah.
Someone else lost your money and you're the one that paid for it. That is absolutely,
yeah.
Oh, sorry. I'm sorry.
Yeah,
for interrupting, but that's so bad. I feel so sorry for you.
That's okay. It's just surprising I kept going after that. Yeah, maybe I'm just stubborn. I think that's another good attribute of traders, is just being stubborn. So yeah, I actually got my first payout from them. They've finally been taken through the whole court process. So it's like over 10 years on, and got my first allocation from that. But yeah, not that it means much now. But yeah, so that's the first, is always choose like a reputable broker, because there's nothing will set you back like that. And I worry about that a lot. And a lot of people I know here in the crypto space are sort of just going all in on sort of these brokers that I think could very well disappear with the amount of leverage in the system if you have a blow up, or you have a situation where they kind of socialize losses. So they sort of say, oh, because there's been such damage done, we're just going to, everyone's going to have to share the loss of sort of 50%. And something like that. So choosing a good broker, number one. So I'm with IB. I've got no affiliate or anything with them. Both my accounts are with IB, and I should almost diversify more as well, because yes, still, even though they are in my view, the safest, I know quite a few short sellers, and some of them even own the stock. But yeah, should probably still diversify to an extent from that. So as per starting again, I really would do exactly what I'm doing, because that's the thing with I love with trading, is it really doesn't matter if I'm putting an order in for $100, $1,000, $10,000, yeah, and so on. It's the fact is, if you start practicing good position size, and you can sort of stay with the trades and let them really run, then you still get the same sort of outcome. So that would be my recommendation, is just to be patient, and also let your money work for you. Like I think a lot of people have this idea that they can kind of, like, they have to go sort of 100% in and do crazy trades to build up their wealth. Pretty much all my gains have come probably 2-3 years into holding something. It's always like a hockey stick at the end. So it's the idea of doing the work, having conviction, and being able to hold it, because all the big gains come years into most of the holdings. I've almost never had something where I've made sort of crazy profits straight away. Like that, it's not the way the market works. So having conviction and being prepared to hold it for a really long time, and that comes with doing the work on the companies you own. So even with sort of 10,000, just put it into what I currently believe, and then just trying to work hard, save more, and invest a lot more from there moving forward, because it was honestly right throughout my 30s when I was working in asset management, I kind of got to a stage where I could have started increasing my lifestyle, and I just kept increasing my my saving rate, my investment rate. I think for a while there, I was up to sort of 60, even maybe a bit higher of what I was saving of my salary. And then I was starting to do quite well on the investment side as well. But those two combined is how I really managed to exit the whole corporate game. So yeah, that would be it. Avoid all the get rich quick schemes. No one ever gets rich short-term trading or day trading or chasing anything. Generally, the more uncomfortable you are when you enter something, the better the long-term payoff. All my best trades have been absolute gut wrenches putting on. Usually I don't even put them on myself. Like working out, putting the buy order in and sizing it up and thinking, because you can be quite objective when you put sort of a limit order in the market and say, if it trades down there, I would be super happy. I'm thinking in March now, I had some very large orders in the market, and some of them when I got hit, because some particular position, I'm thinking one position now, I had my average cost in the position where I had conviction was sort of 12 cents, and I got hit on a very large order at 4 cents. And that, even though I should have been happy, it was absolutely gut wrenching, because your mind instantly goes to this is going to zero. I'm gonna absolutely dust. And so having those limit orders that take your own sort of emotional weakness out of it is hugely important as well. And so that's something I should probably talk about more, is like the whole sentiment side of it, like being able to put on when everyone else is freaking out. It's easy to say, extremely hard to do.
So when you put on these trades, when you say a trade, or do you consider it trading or investing, are you trading in and out of the position, or are you just holding on to it the entire time that you put the trade on? I think you said a couple of years. You're just holding on to it for that, or are you adding in? Are you selling as it goes on, as you get profits? What does that look like as you're holding this thing?
Yeah, so that's a question I always get, is like, call myself a trader, and it is because I am quite active with a lot of option strategies. But and I consider a lot of these companies I'm invested in as cyclical, so I consider them trades rather than investment. When I think of an investment, I think of something that is kind of like a Buffett type hold for life. And so my average trade at the moment is probably 5 years, I guess. And so that kind of doesn't sit with like people, well, that's not trading, that's investing. And so yeah, definitely blur the line there. But I'm very active in if I see something that, like, I queue a lot of if we get market smackdowns and something goes down far more or holds up better, then I'll start sort of rebalancing. So I rebalance between names quite well, depending on how they're reacting to news. And so that's kind of where the trading comes in. I do a lot of option strategies around my positions if they have an active option market. So the likes of some, if they just run far too far and the IV gets too high and I'm just uncomfortable, I might turn it into like a covered call. Or if I want to start getting out of the position, I start gradually selling more and more call options against it, so that I could get exercised out and also get the additional premium. And if I generally don't add to positions, which is kind of is a weakness, and I would have got a lot more returns. But at the same time, you have to compare that to, I'm always trying to be in the most hated sector. And so if that capital is constantly working hard by going into areas where people just despise it, then I don't think there is much of an opportunity cost, because again, that whole example of kind of all the returns are sort of 3 years out, as I'm constantly like planting those seeds. And if I kind of concentrate on the side of my portfolio that's doing well, that's just misleading. That's just ego, just thinking that you can do better by adding to what's working. It's kind of like a sort of a flaw in human psychology, is just wanting to concentrate on the one thing that's working rather than going to the next painful thing.
Is there anything, as you're in these trades, what do you monitor to make sure that they're working or not working? Are you looking at like inflation rates? Are you looking at 10-year yield? Are you looking at any indicators? And if you're looking at anything, what are you looking at to monitor these investments? Or is it just purely technical analysis? What are you looking at?
Depends what company. Obviously, a lot of these, I'm more concerned about sort of getting diluted in poor management execution, because I am in some sort of like, you know, the uranium space now. I was in some companies that didn't have any revenue, and I wanted to make sure that they're not going to hit me with a big crazy raise. So mostly looking at sort of cash levels, burn rate, seeing how they're reacting. I love doing, I see you use TradingView. I love using charts where I map out the whole sector and see how they're all, yeah, I guess it's almost ratioing between companies in the sector and seeing how they're all sort of reacting across. And if one's a laggard, I won't stick with it for long, even if I like the team, if it's just not reacting to news. And so I've done that quite often. It's just rebalance. So yeah, it's a combination of seeing other team actually executing, because I've often it's the thing that gets misunderstood the most is when I say I sold a loser. It's not because it was going down. It was not because it was actually a losing position. It was because I was displeased with like management decisions or execution or how it was being perceived by the market. And I've decided to move on to something that's because winners often stay winners, and that's something I've kind of learned a lot. Is I see it across the uranium space a lot. People stick with their and keep trying to push their company, saying it's like provides more value than others, and that's why it's been underperforming. Well, no, in my experience, it just keeps underperforming, and the outperformers keep outperforming. And so that's something that's quite hard to stomach, is when you have to admit that you've been wrong and rebalance into something higher when there was sort of an opportunity cost there. But generally over the longer term, that's really paid dividends as well, understanding that.
How do you identify those winners? Like, what do you use to identify? Is it all fundamental analysis, technical? Is it the combination of both? Are you looking at the fundamentals and saying these fundamentals are probably going to outperform the others in this group? Or is it something technical analysis wise, like the way it moved off the bottom, the volume, or something that cues you into which company to go into? Is it?
No, I don't generally use technicals at all. It's all, yeah, it's 90% fundamentals, and also very, very heavy on the sentiment. I love that's why I like Twitter so much. I like when I see people freak out. I kind of use a lot of sentiment gauges, like what was going on in March, sort of the middle of March last year, was just everything I want to see. It's just when you understand everyone's moved from any rational thought to just pure liquidation, that's when I get most bullish. And that's I don't think you can't really call that even fundamental. I don't know where that falls in more the sort of arbitraging human nature, is just waiting for people to panic. And that's where I've always built my largest positions. That said, the fundamentals do play a huge part in having the conviction to really, really like lean into positions when there is the sort of the panic and the sell-off. And so a lot of that just ties back to managing my downside. I'm just going through the numbers, trying to give myself, that's why I talked about the post restructurings. Generally, then you get a very big sort of margin of safety, I guess. Like all the debt holders are now in there with you, and they don't want to see it go into Chapter 11 again on them. So generally, they've given a good cash cushion. They've restructured all, like the debts are all sort of rolled out 5 years, because ultimately everything I'm in is highly cyclical, and I know you're just trying to get across the line. Like once you're across the line and everything turns, like we're seeing in uranium, they won't have any trouble raising more funds, and it'll all be fine. But it's that risk of kind of like some oil companies now, particularly in the offshore space. Like there is still some that if we get a whole new variant and we all go into a lockdown for another year, I question if they've got enough cash to get across the line. And so I don't want I don't want binary outcomes in my portfolio at all. I don't care for this will be a 20 bagger if this license comes home, or this will be amazing if the sector turns around quicker than, like, I don't care for that. I'd prefer to have 100% of my capital staying engaged and working. It's a similar analogy that I use with sort of like people talk about tail risk hedging, and you're constantly burning capital every month. And then when they get the big payoff, they talk about how it was like a 50x, but then they don't include all the previous capital. So the way I kind of view my strategy is I'm going in smaller companies, but I intend, and I view them all as kind of like call options on the sort of commodity cycle, but I want to keep all that capital engaged. I'd like to keep sort of maximum exposure to the sector. And so, yeah, that's kind of the overview.
And you said you kind of lean into positions when you take an oversized position, or you want to apply more capital. What kind of position sizing do you have per position? Is there any limits that you put yourself? How do you handle that?
Yeah, so this is something I forever am asking other traders, because it's something I'm always trying to optimize. It seems like everyone just has a preference in what works for them. So I always came at it from how can I minimize the damage, because I know the damage that it's obviously very hard to make your money back just percentage wise if you cut a position in half. And so how to minimize damage, and yet how to also ensure that it has a meaningful impact on the portfolio. Like if you have obviously a 1% position and you 10x, it's still only 10% of the portfolio, and it's not that meaningful. So most of my positions, I've ended up, my sweet spot sort of seems to be around 3-4%. And if I have high conviction, push it up to 5-6, and very, very occasionally, kind of like March last year, if I've got conviction, I'll push something up to 10, but that's maximum. 10 at cost is as high as I'll ever go. And so that's my kind of framework. And I might increase that 10 by using option strategies around it, like bull calls and trading around it in that way. But yeah, over cost, I won't go above 10.
Yeah, that makes sense. That's exactly what I do. I go about 5% is kind of somewhere where I start saying, okay, this is pushing the limit, but 5 to 10% would be an oversized position for me, for sure.
Yeah.
So yeah, I'm the same exact way as you. Is there anything else you'd like to talk about or bring up that you think investors should know that maybe I'm not asking you, or maybe something that would benefit them to become a better investor, whether it's learning something, going and researching something that made you a better investor or trader?
Yeah, well, I guess there's one that I would like to touch on. It's just the difference between like forecasts and just understanding like knock-on events. Like I've mentioned a few times, I think there's going to be crazy food prices going into next year, and that's quite a big forecast. Or I guess it is a forecast or a projection, but a lot of the stuff it's actually quite sort of 101 logic when you consider natural gas goes higher, fertilizer goes through the roof. You can look at past correlations between fertilizer and food, generally with a sort of I believe it was a 6-week lag. It's about 0.8 correlation between fertilizer taking off and food taking off, which just makes sense. So it's not actually much of a forecast to say food is probably going to really run, and then just see which crops are the most nitrogen sensitive around the world. And then also keep your eye out for like articles like we've just seen Argentina are going to now they're curtailing all their exports, and they're, I think, the third biggest sort of grain producers in the world, and they're gonna keep a lot of it for themselves. And you just see a lot of stuff, and it's not a stretch to understand where this is going now. I don't really cause forecast, and then you go through your whole universe of ways to play this and try and find the best risk reward payoff. And so I think people make this game a lot more complicated than it needs to be, especially if you focus on supply. Like there's a section in what's it called? It's a collection of marathons, that is capital returns. That's what it's called. And they've got a whole chapter on it when it said always focus on supply. And people love to play around with demand curves and project a certain amount of demand out to the future. But that's can be very variable and very open to interpretation, as we're kind of seeing with a lot of like EVs, for example, the sort of demand for EVs out to the future. If you focus on supply, then it always stands you in far better stead, because supply is hard to bring on. And I think it's going to come a lot harder with what we've talked about in energy today. And also labor. I've got kind of a big picture view that we've kind of reached the peak in capital, and moving forward, not only is, it's funny because in all economic models, they always focus on labor and energy gets left out. But when you kind of, the two are kind of like energy is a leveraged, is what leverages labor. And so the two are completely intermingled. And I think we're going to see a decade of, the decade of labor. We're going to see labor costs explode and energy explode with it. And so, yeah, that was, sorry, I forgot your original question. Got the tangent.
Yeah, there's another question too that I have. A lot of people, they go from YouTube channel to YouTube channel. They go from pundit to pundit or whatever it may be. How do you know when you're listening to someone? Because I mean, I could be listening to Cathie Wood, for example, and she's saying that her fund is deep value. And when I look at it, I get a little bit confused. I'm like, how the heck is this deep value when looking at it? How can you tell who to listen to and who not to listen to? I mean, how do you kind of decipher that? But between someone you should and shouldn't listen to?
Unstable internet.
You want me to answer the question or ask the question real quick?
Yeah, please. I missed most of that. You froze. Yeah.
Okay, so I was asking, someone like Cathie Wood is saying that her fund is deep value. And when I look at it, I don't see that deep value. I'm like, what the heck? So how do you determine if someone is okay to listen to or is not okay to listen to on YouTube? Like, how do you decipher who knows what they're doing and who doesn't know what they're doing? Like, how do you sift through that? Maybe there's not a good answer for it, but a lot of people get confused because they'll hear something, they'll read something, they come back to my channel and they say, this person says X. And I'm like, well, I don't think X is going to happen. It's just, that's like crazy talk. What do you say to that? Like, how do you fix that or deal with that?
Yeah, a lot of this is actually super tough, because the thing with investments is everyone can be a genius with a coin flip if you get it right with leverage. And the only way that really the better people come out is over time and seeing a good process get repeated. And so it's kind of human nature that we all fall in love with Cathie, who has kind of has had the right strategy at the right time with leverage. She pretty much created the non-profitable Goldman Sachs tech index, and she got inflows in which she used to pour into quite illiquid positions. And so it was a beautiful reflexive cycle. And so the inflows beget better performance, which beget more inflows. And this has happened before. Like there was quite a few sort of similar names in the .com boom, and they're always darlings. They you can see that the majority of the inflows were when it really started outperforming. And the problem with that is that it's a two-way sword. Like, because she's in illiquid positions that she bid up herself, as soon as it kind of you lose the additional marginal buyer, then everyone quickly gets underwater, and that kind of gets put in reverse, in which she's now got to sell these illiquid positions. And unlike sort of a fund that can gate funds, she has to meet daily liquidity. So she's going to kind of blow herself up very quick. And I think that's what we're seeing the start of. But to answer your question, how to like spot these people, it's just the obsessive popularity with sort of outperformance. Like you should always be very wary when people are performing over a very quick period, and you can dig into a process. And a lot of what she says, like you can go through her forecasts on Tesla, it's just rubbish. It's just complete rubbish. She's kind of invents like a whole new insurance business that'll be the most profitable insurance business, doing margins that no other insurance business has ever done. Tesla will completely create it in the next sort of 5 years with no additional capital needed to be raised, because we'll be doing it off profits that the underlying company, and you just realize it's rubbish. The process is rubbish. She's been right on the stock price, and this is a conversation I constantly have, argument I constantly will debate, hopefully, is the fact that a lot of people like to kind of associate outcomes with like the quality of thought, whereas it's kind of similar to poker in that you can have bad outcomes, but if you've got a good process, you've got to kind of stick at it. And we're kind of idolizing people that have a bad process but have had a fantastic outcome, and that's what I think Cathie Wood is, and a lot of people that have ridden the likes of Tesla and a lot of these non-profitable is they had the right outcome, and they've had also crypto's a big example of it at the moment. Is people are just looking at the returns and the outcome rather than the process, and sort of wanting to dig into it at a deeper level and say, is this gonna work over a longer period? Like, can I go back and look how this has played out historically? And yeah, it's the people that have been, like, I love Howard Marks. I love reading about people that have just been around forever. Like, he's just been through multiple cycles. He understands cyclicality. You understand that generally everything in life is highly cyclical, and it's because of humans being the way we are. And it's the way you defend yourself against getting sort of sucked in by the likes of the Cathie Woods of the world. Is you understand stuff's cyclical, and so you go into stuff when it's hated, and you can clearly understand why it's still necessary in humanity. Kind of like energy, as we've kind of touched on. Without energy, humanity will be back to the Stone Age very quickly. And so it's kind of as long as you spread your risk and understand how to give yourself a margin of safety, then you set yourself up very well. Whereas a lot of what Cathie's investing in, literally, I think, won't need to exist, or will, or similar to like the .com boom, if there is some intrinsic value there, kind of like you could use Microsoft, even, like a fantastic company, that a lot of what they said they would grow their revenues, it all came true, but didn't mean you didn't lose kind of 85% of your money along the way. And so understanding the level of speculation in an asset, even if you really like the asset and the trend, not many people can separate those. And that's kind of a mistake I see people going over and over again. So just avoiding any sort of any crowded trades or any excitement and excess speculation. Always be looking at areas that are just bombed out and unloved. That's the way I do it anyway.
And then the last question I have is, what's the exit strategy here? How do we get out of it? What do you look at? What do you look for?
I love this. This is the biggest question, because this is what kind of will separate us from many other sectors where you kind of get the diamond hands hold forever. It's what most people forget with investing, is everyone is paper profit millionaires at some point of a cycle. But what really separates the old hands is the fact that they can actually be objective and get out. So this is the thing I feel most passionate about. I've written a blog about it, called it the monkey trap, because it's just using the analogy of the way you can trap a monkey is by putting nuts in a coconut with a slightly smaller than a fist-sized hole, and the monkey will reach in, grab all the nuts, and then the hunter will come to get the monkey. The monkey can escape, but he just has to release the nuts to be able to run away. And the monkey's greed means he won't release the nuts, and so he gets caught. I feel like this is the exact analogy for people are unwilling to leave any gains on the table, and as a result, they'll get murdered by the market and come away with nothing. And so the way you counteract this is by gradually scaling out. First, I use about 50% fundamental factors and 50% sort of behavioral. And so I like to sort of think of scaling out sort of very gradually. So like maybe 5%, so to just use examples, because that's what I wrote about with uranium. It could be when spot overshoots term by a wide margin, maybe $20, $30, and they're both already well above the sort of incentive pricing. Maybe they're somewhere north of 100, and you see it really overshoot, then that's going to be 10% taken off the table. You see a behavioral one might be like the taxi driver turns around to you and says, "Oh, are you in uranium stocks? I just bought some, like another 10% off." And so you're constantly reducing your portfolio as you see. I've got like a whole list of sort of like obviously mum kind of knows what I do, so she might ring up one day and said, "Oh, how's your uranium portfolio? I just saw it on the news tonight that uranium's the best investment, like another sort of 10%." And so you just have this gradual scaling process, and you accept that you're probably going to be down to your portfolio is going to be a fraction of what it was when it probably has the true crazy spike, but you just can't be involved in that. That was I think Jim Rogers said it with silver. He said he got out 1 month before the peak in the silver bull market. He missed half the move. It's there is that crazy speculativeness, but you can't be involved in that. And something else that gets left out of this whole conversation is what you're rotating into. So if you have another theme that you're quite comfortable with and think has good upside, it makes it easier to scale. So I've been quite vocal on thinking that I hope I'll be rotating out of sort of a speculative frenzy in uranium into coal, because I don't think coal's ever going to catch a bid. I think everyone's going to continue hating it for the next decade, and it won't get that sort of speculative blow off top. And so it'll be more like the tobacco trade, which went on for decades, with especially if you just kept reinvesting your dividends in the underlying stock, and nothing. It won't do anything spectacular. I think everyone focuses too much on the likes of what some of them have done, like Peabody post its almost second Chapter 11. But the average one will just grind out solid returns. And if you look back now, I think it's the greatest, it's the highest performing sector was tobacco over the last few decades. And so to be positioned to take a really big boom and bust win and set yourself up for real wealth and hold on to it for the long term, because that's what a lot of people get rich, but not many people like hold on to it.
Okay. How can people contact you if they want to contact you, or how do they find your website that you have? Where do they find you?
Yeah, so I've got Twitter, where I'm reasonably active, and also I have a newsletter. So that's just on my website on traderferg.com. And yeah, I do 2 weekly videos on Crux Investor, which is where I've just started interviewing people and also saying what I'm doing with my portfolio. So those are kind of but yeah, just join the newsletter and I talk about it quite a lot there. So those are the main ways.
Okay, well, I would really like to thank you and appreciate you for coming on the channel and spending your time here and educating us on what your viewpoint is on how to build wealth, market timing, all that stuff. So I really appreciate it. Thank you for coming on the channel, and hopefully you can come next time if you want to. So thank you.
Love to. Really enjoyed it.